Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Leverage is determined by the strategy selected and the strike price chosen. Options give you a lot of choices since there's so many different strike prices. And each individual trader / investor can decide based on their own goals and their own risk tolerances. Slide 36, I think this is a great slide because I tried to categorize the reason and why we're all here today talking about, again, I'm talking about which strike price to trade. There's never a right answer. But once you understand you have, number one, the in the monies, two, the at the money, and three, the out of the money, you can sort of put it in your mind or create little buckets of where you think the market's going. And not only that, think about the risk of the trades. You know, you might say to yourself, oh, and I've heard this before from investors that are new to options. They say, oh, I like trading in the money options because the deltas are higher. That's true. The deltas are highest at the money. Great. So now I know that the deltas are highest at the money. Does that mean I should always buy in the money options? Well, the problem with that is that I'm getting high deltas, but I'm also getting high cost. If I look at the out of the money options, the deltas are lower, but my cost is lower. So you'll see that there is that relationship between deltas and the cost. Delta is a probability. There's a couple ways. The practical side is the probability of the asset moving beyond that strike price through expiration. And there's also a more scientific way to look at it. It's the hedging process that market makers and institutions use to hedge the investment. So there's either way, depending on how you really want to look at it. You'll notice that the at-the-money options, other than time decay, where the time decay is so great there, but other than the time decay being high, have more moderate results. So the deltas are moderate, the leverage is moderate, the cost is moderate. The only problem there is that your time decay, since you're buying all time, you have the time decay being highest. I hope this all makes sense. You can go back and watch the archive, grab the slides again, read them. This, I think, will be a very helpful slide that you can categorize the different parts of risk in an option as it relates to delta, the time decay, or what's called theta. For those of us that are trading spot and are new to options, you know leverage, so you can relate that leverage and then the cost. So let's go back to comparing 6-week and 15-week options. And this is something you could do tonight, tomorrow, whatever. You could break down an options chain into many different columns, such as cost, your break even at expiration, what happens if the market stays unchanged. You'll notice here that if it's unchanged, I actually lose very little in the in-the-money option, lose more at the 103 level, and then the 105. The 105 should actually be the greatest. The 103 is, this is a slight mistake. It's going to be $1 something, so that's a mistake there. And so you would go through and understand that there is that relationship between the cost and your if unchanged. 15-week options, the same thing. I can compare 6-week and 15-week puts. Look at the cost, the break-even at expiration, which is important to recognize. Again, my break-even at expiration, I needed to move way down if I'm looking at the 101. If I'm looking at the 109, I only needed to break below 104.75. So there's lots of ways to take a look at this. Options are dynamic. Premiums change each day based on the exchange rate, the time left until expiration, the underlying price, and the cost of money. The in-the-money options are going to act most like the exchange rate. They're going to have the highest deltas. At the money will have moderate deltas. They're a hybrid of in and out of the money options. The out of the money options are going to act like potential long or short delta, but initially they're not going to act too much like it. They're going to have very low deltas. So you have moderate, I should say high, moderate, and then relatively low. In the money options cost the most. At the money options have less nominal dollar risk than in the money, but they have more nominal dollar risk than the out of the money option. The at the money also carry a more balanced risk reward as relative to in the money and out of the money options. And out of the money options will have the lowest dollar risk. That doesn't make them best, but it just means that they have more leverage. So which one should I trade? 6-week, 15-week? Well, there's lots of choices. So let's take we'll go through some examples here. If I look at the 101 call, remember I was trading 105.18 or whatever. Let's see, where was that trading? At 105.18, I have my cost and my delta. And again, this makes sense, is that the cost is going to move down. I'm going to take that back. So the cost is going, I'm going to do this here. Cost is going down, but my deltas are also going to move down. So what might you look at? The at the money is what we might all start looking at. The 6-week at the money option traded for $2.13. If you thought that the U.S. dollar against the Canadian was just going to move moderately, you might buy the 103 or even the 101. If you thought it was going to be a bigger move, maybe you were going to buy the 107 because you thought it was going to 110. If it goes to 110, what's that option worth at expiration? It's going to be worth $3 at expiration. I'm going to make $1.82 on only a risk of $1.28. So that's the way you need to think of it. Now, if it's going to 110, I might say, oh, the 105 is nice because I'm risking 213 to make 287. Lots of different ways to look at it. The 15-week options, they're going to cost more. So the cost is higher here. 15-week call, even the 15-week put, although I'll get to that in a second. So the calls are going to be more expensive. And believe it or not, the deltas of the in-the-money options are going to be actually a little bit less. That's why if you really were pretty certain that the other wire is going to move up over a certain period of time, you might want to buy the shorter-dated options. Shorter-dated in-the-money options are going to have the highest deltas. And then as we move out through time, the deltas drop. You notice that the 15-week 101 is about what the 6-week 103 delta is. Very interesting. The at-the-money options, the deltas are about the same, but you'll notice that the price is a lot more expensive. Why? You have more time. And if you go to the 107 and 109, of course the cost goes up, but what's interesting there is that the deltas are actually higher as we move out of the money and we move out in time.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.